Hi, everybody. Welcome to another New Hampshire Business Review webinar. Our topic this month is business succession, divorce, life changes, and business ownership. It's a topic we've written about and covered in New Hampshire Business Review for literally decades, as business owners know, and I've been told many times that a good business succession plan needs to cover many scenarios, like death or divorce, things that are even unexpected. But even one, they often fail to account for those unexpected life changes. So today we have our expert panelists who will go over the key factors owners should include in their succession plan and how to protect the business they built while redirecting its future. Well, before we begin, I'd like to first take time to thank our sponsors today. That's Atlantic Management, McLean Middleton, Shaheen and Gordon, and Service Credit Union. Now, before I do introduce the panelists, I was just going to say that we'll talk a little bit about our format. At the start, each of our panelists is going to present a short overview of the topic, from their perspectives. And after that, they'll be taking your questions. And I'm encouraging you to do it. I assume that's why many of you are here, is because you have your own specific questions to ask them, and that's the point of the webinar. And you can submit them in the text box there. There's a box there where you can just send in your questions, and we'll get them, and I'll curate them and make sure that everybody gets to get as many people as possible get a chance to have to ask their questions. So let me introduce today's panelists. We have Sean O'Connell, who's a partner at Shaheen & Gordon and chair of its corporate and business law group. He has more than 25 years experience in helping clients manage the life and health of their businesses. We have Earl F. Rossi, who's senior manager of commercial lending at Service Credit Union, where he leads the lending staff's activity in originating new loan opportunities and managing the commercial loan portfolio. We have Patrick Clausen, who's a director at McLean Middleton and chair of its corporate department and healthcare group. He's a corporate and transactional lawyer who helps clients form, grow, and sell their businesses. Finally, we have John Murphy, president of Atlantic Management, who coordinates the firm's employee stock ownership plan, merger and acquisition, and ownership transaction activities. Now, the first one I'd like to call up is Sean O'Connell from Shaheen & Gordon to help to introduce himself and maybe touch on a couple of topics that he thinks we should be talking about. Welcome, Sean.
Good morning, Jeff. Thanks. Good morning, everyone. Sean O'Connell. I've been at Shaheen & Gordon since 1996. I work primarily out of our Dover office, but we have offices in Nashua, Manchester, Concord, and Portland, Maine. It's a broad topic today, and I've been involved in, I don't do divorce law, but sometimes divorces become relevant to business succession planning. I've done a lot of creation of businesses for many, many years, and a lot of assisting clients dissolving businesses that were not designed to be dissolved. So I think today's an interesting topic. I think we have a lot of people with a lot of questions have already come in. I look forward to the discussion.
Sorry about that. Thanks, Sean. Now, I'd like to introduce our next panelist, who will be Earl Rossi from Service Credit Union. Welcome, Earl.
Well, good morning, Jeff, and all attendees. It's a pleasure for me to be here with you this morning. I've worked in the banking industry for many, many years, and most of the banks I've worked for in the commercial lending area, we deal with smaller, family-owned, privately held businesses. Many times we're dealing with these companies over a period of decades. And I would tell you that nothing impacts the bankability and the financial ability of a company as a change in ownership, a change in succession. As mentioned previously, these things can come up by virtue of divorce or death or retirement or the next generation taking over. And there are some very dramatic impacts that are felt in the company when these things happen. Very often these things happen after a relatively long period of time that the company's been in business under very stable ownership and management. Very often those companies are very successful in what they do, have, very strong competitive and financial position, and all that can change dramatically. And I think that for the existing owners who are departing, and the new ownership that's coming in, or the change in ownership, there's a lot to think about there in terms of how to keep your organization strong from a financial and a banking point of view. And look forward to contributing to the conversation today about those factors. Thank you.
Thanks, Earl. And now we have Patrick from McLean Middleton. Welcome, Patrick.
Thanks, Jeff. And hello, everybody. So Jeff, as Jeff mentioned, I'm a lawyer with McLean Middleton. We are across the state in Massachusetts. I chair our corporate department, and we work with privately held companies. When I'm working with clients, I think that this issue with regard to succession planning is really probably one of the most challenging issues. We encourage clients to be thinking about this, at their formation, when these discussions sometimes are easier to be had. But as businesses grow, develop, things change, the plan and the path to succession and transition to new ownership is often a challenging one. And unfortunately, it's one of those situations where there's not a one size fits all. So I look forward to engaging in discussion about some of the issues, some of our experiences, and some of the challenges that business owners face when planning for succession.
Great. Thank you, Patrick. Now, our final panelist is John Murphy of Atlantic Management. Welcome, John.
Good morning, Jeff. Good morning, everybody. I'm John Murphy with Atlantic Management Company, and we are a valuation and financial advisory firm in Portsmouth. We also have an office in New Orleans, Louisiana. It's the topic today of being divorce on one side and say succession planning on the other is really diverse. And the divorce aspect really comes without a lot of planning, as Sean had indicated at the outset. And then on the topic of ownership transition, really for most companies, that ownership transition is going to take the form of one of four alternatives. It's going to be a gift or transfer to family members. It's going to be a management buyout of some sort. It's going to be a third-party sale to a competitor or a strategic company within the company's industry, or it's going to be what's called an employee stock ownership plan, or an ESOP. And our firm does the valuation work to assist business owners with understanding what their options are, and then we also are involved in helping facilitate the transfer of ownership using one of those four vehicles, or at least evaluating all of those or some of those vehicles or opportunities or options, and then deciding which one makes the most sense. So I too look forward to the Q&A. It was decided here that rather than the four of us talking heads give a presentation on what we thought you want to hear, it was more designed to do a Q&A so that folks can ask their questions. I know Jeff's going to facilitate that for us, and then hopefully we're going to get you all the information and all the answers that you need from today's discussion. Thank you so much.
Great, thanks very much, guys. And if you could all join me now, that would be helpful. So I'll know if you guys are you paying attention. I know our audience must be, so that's good. Anyway, first of all, I think I'd like to get started just by asking a question in general. It's what happens when a business doesn't have a succession plan in place, or even an adequate one? I mean, you guys have any stories, horror stories about this that might be warnings to people about it? I mean, does anyone there want to take a shot or two?
Sure.
I mean, I can take the first shot from the value side of things. So I can tell you from when we were looking at valuing a company, value is all about risk. And when you look at a company that doesn't have a succession plan in place, and let's say is really beholden to the founder of the company or one or two key people, when we're assessing risk of a business, just like any buyer would assess risk, a company without a succession plan is going to have more risk and hence slightly lower value compared to a similar company that does have a succession plan in place. And so it's never easy, but that's a very straightforward, very straightforward piece or element here that can be addressed. It takes time, but it can be addressed.
Yeah, I think also from a standpoint of having some knowledge of how this will proceed. I mean, sometimes a life-changing event comes along totally out of the blue. Somebody passes away, or there's a family issue, or something that was unanticipated. Other times you can see it coming. Dad, who started the business 35 years ago, is spending more time in Florida and wants to retire, and so you get a chance to work through these things, or partnerships dissolve. I think having a plan allows you to have some roadmap to follow when the event happens. Without a plan, I can tell you from my standpoint, I'm sitting in my office some morning and the phone rings and it's one of my best customers, wives or sons or husbands calling up to tell, oh, by the way, last weekend we decided to do this. And it's like, oh, now what happens? And so there's, planning never makes the process completely predictable or the outcome completely and something you can anticipate, but at least it gives you a little bit of a roadmap to go by when you're confronted with this kind of thing.
I think, go ahead, Sean.
Pat and I had a case together years ago, and it kind of had a number of different these factors that all kind of came together at the same time. We had a 3-person LLC. Pat, if I remember, represented the entity, and I had one of the 3 members. So one of the 3 members, younger guy, got sick and died, and there was no buy-sell or succession plan in place. So his wife acceded to his shares, and that was a very contentious relationship between her and the other 2 guys who were remaining. At the same time, the other 2 guys who were remaining were at war with one another, and they had all kinds of different ideas about how the business would go, and they could not coexist with each other going forward. So in the absence of a succession plan, an express succession plan, we had to work through buying out the wife whose concept of value was very different than the other 2 members. And then we had to work with the 2 members who each believed they were entitled to essentially everything. And it was a very long, expensive, litigated process. I remember early in the process that Pat had a very well-drafted buy-sell agreement that we suggested the parties adopt, but it was too late, and they were entrenched in their various camps, and it was a very messy situation that, had there been that buy-sell or other succession plan in place, wouldn't have happened.
Yeah, and let me just augment that, and then kind of picking up from what Earl said, the goal for most businesses is just having a roadmap, setting expectations, setting rules of the game that everybody can, live by. And they're not going to be perfect, but we do know that life happens and circumstances change, and, trying to prepare for some of those changes so that we can, allow, the business to navigate through them is important. And, this is important not just for the business owners. I mean, certainly John talked about value and deterioration of value, but many of these businesses are, members of communities, are important, have an important role in communities, have employees. And so, thinking about all the other stakeholders that are involved and having a roadmap in place to allow that organization to continue forward. And I think, picking up from what Sean said, I think one of the great things that happens that people have to be aware of is that in addressing these plans is expectations. Because where disputes happen, in my experience, where there are misaligned expectations of what value is, what somebody should be able to receive from the business. And when you have misaligned expectations among different people, you have a dispute. And I will say that the only people that win in those sort of situations, are the lawyers who are fighting, for either side. And, that's not the fight that we want to be part of.
Yeah, and just the one final point there, again, looking at it from my side, me not being the attorney, but being value. One thing we've always said is that when business owners, whether you have two partners or multiple partners, are getting along, that is the easiest and best time to put a shareholder agreement or a buy-sell agreement together, when everybody's getting along. And once that's in place, oftentimes it'll be, maybe there's insurance that's there as well for it, but once that value expectation is set, like, for instance, if we come in and do evaluation to help set what's the value today at the end of 2021 for a buy-sell agreement. Oftentimes we can provide formulas, and the business owners can use those formulas and set value every year thereafter for, say, 2 or 3 years, without having to go out and get another formal valuation or something. And maybe the 3rd year or 4th year or maybe even 5th year, they'll go out and have another valuation done. But it's really helpful to have the buy-sell agreement or shareholder agreement in place. But it's equally important that if there is a value piece or mechanism that's put into these agreements, that the shareholders do get together once a year and agree upon the value the following year and the following year. That's the one piece when we get involved in these situations that we see, is that the attorneys do all the great work, the shareholders do all the great work to put these plans together, but then nobody follows up the following year and the following year. And so now you're at crossroads again.
And Jeff, I would add too that, your first question was, what happens if you don't have a plan? And I think, Pat and John and Sean all spoke to the same thing, as did I. Without a plan, if things get very contentious, if there are divergent views of surviving partners, this all takes focus and energy away from running the business. So not only are the players squabbling and fighting each other, they're not talking to each other, they're talking through their attorneys, they're dealing with spouses who have different agendas. The business is going to hell in a handbasket. Many of these businesses, we're not talking about General Motors here. We're talking about, at best, regional companies that do very well, but they require the constant focus and attention and coordinated effort of all the players. And if they're fighting with each other, as a banker, I'm constantly looking at the risk associated with some of these companies. And, within 6, 8, 9, 10 months of a protracted transition, you can see the financials just erode of these companies. And to John's point, there goes the value. And if you've been fighting over it for a couple of years, there may be nothing left to fight over. So, better prepared makes a big difference. So.
Yeah. We have a question from one of the attendees, and it's about a sole proprietorship, sole ownership. And he said he's interested in strategies to keep the business running or prep for a sale if the sole owner passes away unexpectedly. How do you prevent a disaster in this case? And he has another question: what actions should we take now if a key employee is interested in taking over in that situation? Is anybody willing to take a shot at that?
Sure. I mean, so I'll leave the sole proprietorship of the entity to the two attorneys. But in terms of preparing the business, whether it's a 3-person business or a 30-person business, if the goal is to have somebody from inside the company take that over and potentially purchase that business from the owner, the one thing that we oftentimes will see is that the business owner is more entrepreneurial. They've taken that initial risk to start a company or buy a company. They may have taken out a mortgage on their home or a home equity loan to support this, where employees oftentimes are just worrying about their day-to-day lives, etc. And they're not necessarily saving or putting any money away to actually buy the business. So the very first thing I would say is that from a business owner side of things, is if the goal is potentially to look to the management team to have somebody acquire the business, start having those conversations with them now to see, do they have any dollars or capital set aside to do this? A lot of times management or key individuals will look to the company to basically give them more in payroll or more in compensation, to give them the money to buy the business. And which means that it's a very prolonged payout to the selling shareholder, to the owner of the company. It's not tax advantageous whatsoever because there's a lot of taxes being paid there. So that's really honestly the very first thing to look at is what is the wherewithal of the individuals to see if they have the ability to actually buy into the company, or if they're looking to the company to support that purchase.
I think I agree with John. I think that in the matter of a sole proprietorship, or a single member LLC, you're really kind of flipping into estate planning unless you have an actual plan for how you're going to divest yourself of that. So if you have a deal with an employer or a group of employees that they're going to buy from you or something like that, I think on the single member, it really just follows your estate however you set it up. There's not much else to be done about that. It's definitely a matter of an employee purchases what the employee has, and then it also, to probably more in Earl's wheelhouse, what kind of credit can that person generate? What are you buying? Is there SBA availability? What can you do to step up and borrow commercially to along with obviously a significant equity participation from that person. But it's often tough for an employee to have generated enough cash to do that. I just had a client who wished they could have sold it to the next generation, but they couldn't. The value of the business and the real estate had grown to over $20 million, and the next generation down didn't have the capacity to either buy or borrow to step in.
We do see this occasionally. There's very thin management, like a single member LLC, or, as was mentioned before, an organization with 4 or 5 people in it, and the next person is going to take up from the owner. I think the question did mention, in case of the death of the owner or something like that. I haven't seen it used lately, but very often in these situations, you'll see the company before the event, purchase some key man life insurance, where the proceeds go to the company and go into a fund to help in the transition and fund some of the things for the heirs and the beneficiaries, and then aid the management transition, even take care of paying off some debts of the company so that the next generation doesn't have to assume some liabilities that, coupled with everything else, they really can't afford to pay, to Sean's point. That's kind of a difficult situation. I had a situation with a medical practice, a dental practice, years ago, where it was owned by a single dentist. It was a very, very successful practice. He had 3 or 4 associate dentists with him. He died very unexpectedly, no warning. And he had run the whole thing. He was the single owner. His wife inherited the business from him by virtue of the fact that she was his wife, but she was not a dentist. And in the state of New Hampshire, you can't own a dental practice, unless you are a dentist. So she had to sell the company to one of the other associates. And it took some creative figuring out to figure out how 1 or 2 of the other people were going to be able to step up and do this with a practice that was worth millions of dollars. So, I would think about maybe some key man life or trying to get some insurances in place here to help with these eventualities if they happen.
Okay, Patrick, did you have any thoughts or?
Yeah, the only other thought I have is I think we touched on is the key piece is to identify who the buyer is, and and you build from there. And if your management team isn't the buyer, then you're exploring other options. If your management team is going to be a buyer, I think there's a path that people have seen. You just got to recognize that the owner may be assuming some of the obligation and getting paid out over time. So I think once you've got a sense of who the buyer may be and that buyer is going to be committed, then it helps you then orient to what the next couple steps are in that process.
I think to add, I think that if you are a business owner and you have a employee or a couple of employees who you want to have the business after you step out, either death or retirement, you should probably work on arranging that ahead of time. So those people are probably very important to the success of the business. If you're having a discussion with them, they probably have an interest in owning it one day. But you should, waiting until just before retirement or waiting until someone drops dead is not the time to try to address that transition to those people.
That's what they call it, succession planning.
That's right.
All right. Anyway, I have a question here from a woman who says, we are a husband and wife owned LLC filing as an S Corp. Our business is based on our personal property. When we set up this business, I didn't see need to own any more than 10%. What are the advantages and disadvantages about owning this percentage? Is there any thoughts on this? Because I can go on with her question. Because I'm planning on retiring for my husband. What should I be concerned about when I retire regarding the business?
I'm not quite following when talking about the owning the 10% piece. I'm not quite following.
Okay. I always say that my husband has to bury me because I would not know what to do with the business if he died first. Sell it as a business, break it up and sell the assets, close it down. What are good resources for me if he does pass first?
Okay.
Yeah. So the issue that you run into is that there's so many different facts in play in terms of how you approach these sort of situations. And it kind of, which I think is really the conundrum of succession planning, at its outset, is that there's no perfect answer. But so you start with the fact that you've got a valuable business, and you need to assess is the idea here that you're going to continue to hold that asset, let it generate revenue that you're going to be able to take advantage of on a go-forward basis, by putting other managers in place, to run the business. Is that a viable option? If that's not a viable option, then maybe you're left with no other option than to liquidate the assets and distribute it among the owners. And so, there's a lot of different, ways that this can go based on life circumstances, what the goals and objectives are of the business owner, what the market looks like. And so, I think sitting down and working through that, whether it's with your estate planning lawyer or a business lawyer or some other advisor, is really the first step in that process to get a little bit of independence into that thought process, so you can have a sense of what options do I really have in order to move forward, and then start to make a decision on how to move forward.
Yeah, I would agree. I think if you find yourself in that spot too, you could, depending what industry you're in, you could find a broker and try to sell it as a going concern. And I'm not sure the 90-10 is probably all that relevant in this two-person husband-wife LLC. The members can treat and pay themselves how they see fit, and they're probably filing their taxes jointly. So that element does not strike me as being all that important to the question.
Yeah, and
I think
I was going to say, the other piece is just piggybacking what Sean said. If it's a smaller company, reaching out to a business broker, that's the term. They can do it. They can talk with their accountant if they have a referral, or obviously reach out to any of us. We can provide some referrals. talk to a business broker if it's a smaller company. If it's a larger company, you know, firms like ours can at least give guidance to be able to tell the shareholders or the business owners in this case what the market is for their particular business. You know, how saleable is it? How saleable is it? Particularly going back to one of the original questions is if the husband is no longer there and he was a key person, is there a business that left to be sold, or is that part, or is it too late at that point and you basically have to liquidate everything? You know, collect your receivables, take your cash, sell off any hard assets, pay your liabilities, and close the doors. So, which ultimately, I don't think anybody, you know, that's never the goal that anybody shoots for. So, but yeah, besides, as Patrick said, besides talking to the business or state attorney, just talk to somebody to find out how saleable the company would be. Just at least know what the options are.
Great. Very good. Thanks very much. And Elsa, I just wanted to say that, you know, we're taking questions. We're still taking questions, so feel free to send some in. I have a question here specifically about buying or selling a business. And the question is, what are the advantages of an asset-based sale versus a stock sale?
I'll give you the financial pieces and I'll let Patrick and Sean give you the legal pieces. So it really comes down to two factors, really comes down to taxes and risk. And so in a stock sale, typically sellers prefer to sell stock because the tax rate that they're going to pay taxes on is going to be lower. And they oftentimes want to sell stock because they're selling their entire company, everything, the minutes to financial statements, the minutes to board of director meetings, etc. And so in theory, they're passing all the risk of that company up until the day of the closing. So in theory, the sellers can walk away and they don't have any risk going forward. And I say in theory because we always have risk. On the flip side, buyers typically prefer to buy assets because they're not going to assume all that prior and historical risk because they're starting a new business and they're buying just the assets and what have you. And secondly, without getting too deep into the weeds, they can buy those assets and whatever the value of those assets were, the purchase price as of the date of the closing, the buyer can do what's called step up those assets to whatever the value is today and start to redepreciate those assets all over again. So it creates an expense for the buyer going forward, which helps reduce their taxes on a go-forward basis. So that's from a numbers standpoint, that's the reason why you have the two different.
Most often, I think on a stock sale, if a buyer wants a stock sale, it's because there's a contract that exists between the selling entity, oftentimes a governmental agency, that's a very valuable contract that would either be impossible to reproduce or would take a long time to reproduce. And so it's valuable at that moment. So they come and take it for that reason. Otherwise, I can totally agree with John on all of that. I think that in my experience, when you do a stock sale or an asset sale to some extent, but there's a very distinct shifting of liability within the sale documents about who's responsible for what liabilities which occur prior to the date of sale and after the date of sale. Is oftentimes an escrow held back for some period of time. Could be, could be quite a few years that is there to pay for any liabilities that accrued prior and then come forward to the new owner and the stock company. So I think those are most of the, I think that John and I covered most of the reasons I'm aware of.
I think from a banking perspective, a stock sale is a little bit easier to finance than is an asset sale, because when we're looking at the business entity and in a stock sale, the entire business, lock, stock, and barrel, moves from one owner to another. The entity itself continues to exist and it just moves, the ownership of the entity changes. And so there's less mental gymnastics that have to be done than with an asset sale, where you're now trying to revalue all the assets, come up with new balance sheets and values, and what's the step-up value and what's the collateral value. And as Sean said, you know, in a stock sale going across, especially if it's a kind of company that has ongoing contracts, none of that is interrupted. It just moves along. So, you know, depending on what the business situation is, you know, in a situation where a business is essentially being liquidated and closed, and a like kind of business just wants to buy some assets, that's one kind of transaction. But if you mean to sell the business, at least from the banker's perspective, it's a little less complicated, I think, if we look at a stock sale. So that would be my only input.
Great. There's a question. I think I know what your immediate answer is going to be, but I'll ask the second part of the question too. When should you start planning for a succession plan? And then what are the steps that you have to take to start the process?
So let me jump in on that. Yeah, I think, you know, when you should start is, you know, right when you form the entity. I mean, you should be, when you're thinking about, you should be thinking about exit at the beginning. And it's the easiest time to do that. And, you know, you may amend that plan later down the path, but, you know, having something in place is probably the most advantageous. And then I think beyond that, you know, you start to identify, you know, your company grows, develops, and you get to certain milestones with regard to the business, where, you know, you should be looking down the road. You know, any sale transaction to a third party, you know, is probably, you know, something in the neighborhood of, you know, a 24-month process. So you back away from that and start thinking, okay, well, how do I start to, you know, identify, you know, who the right, you know, potential buyers are or who the successors are. And it's, you know, and I think going back to John's point, you know, you do it when everybody's getting along, and, you know, well in advance of, you know, when it's too late.
Yeah, I think when you said earlier, Pat, you talked about misaligned expectations. And at that inception, at that first moment, there aren't any, because you know, everyone is on the same blank page. Then you come in and there's basically, not presuming a sale to a third party, but there's basically kind of 4 different ways that you're going to look at succession. You're going to have your involuntary, which could be divorce or bankruptcy, receivership, something like that, death, disability, and retirement. And retirement could be, sometimes is a broader word that we use, that, you know, it might just be I want out, and you're not actually retiring, but you know, a more of a friendly exit. But you just kind of identify these ways out. Then you talk to John about how you value it in these different ways. And you probably value the involuntary transfer differently than you do the others, the retirement or death or disability. But right, you do it at the first day, and you know, it's when you sign the operating agreement, and you know, either it is included in the operating agreement or the shareholder agreement, or it's a separate agreement, but you do them all the same day, so that you're launching all from that same spot.
Yeah, and from the involuntary side, using Sean's word, it comes back to having that shareholder buy-sell agreement in place, having the right insurances in place. And that's really, you're trying to do that for the situation that nobody planned for. If the thinking is that it's going to be a planned for transfer, whether it's to, you know, a sale to a third party or a sale to an employee stock ownership plan or an ESOP, particularly if it's a sale to a third party, some of the planning that gets, just from a housekeeping standpoint, some of the planning gets done early on is making sure the financial statements are strong. For instance, it's more difficult to sell a company that's using QuickBooks as a financial statements versus working with an outside accounting firm. Now, granted, we're talking about the size of the business. So if you're talking about a small 2, 3, 4 person company, you know, you don't have to get on that path. But if you're talking about a more established company, then having financial statements prepared by an outside accounting firm is going to be more helpful in the process. Making sure that all your legal documents are in check. It's no different than selling a home. I mean, when you sell a home, you don't decide to sell a home and then contact a broker the next day and you start letting people in your house. You clean it up, you stage it, maybe you paint it, etc. Selling a company is no different. So you make sure all your legal documents are in place. Make sure you can find your contracts that Sean alluded to. And then once that's in place, then it really comes down to starting to look and just being aware of what those options are. Like I said from the outset, a transfer to the family, management buyout, third-party sale, or a sale to an ESOP, and just evaluate them and just understand the pros and cons of each of them and see which one makes the most sense for your particular situation.
I think with a lot of relationships, and I don't think business relationships are any different, people have to understand what the expectations are. And, partners in a business, need to understand from each other, hey, how do you see this playing out? And, you plan very differently if the idea is, and I've heard this from many clients, hey, we're going to grow this over the next 5 years, sell it to, some sort of private equity firm and move on. Or, equally, hey, we're going to run this business forever, hand it off to our kids, and they're going to run it and have it be very successful. I think the key part of that in both discussions is, making sure that the owners are in alignment in terms of, that decision has been made and that's how we're going to progress. And then you have all these other protective measures in case, unfortunate things happen.
Agreed.
It brings a question to my mind. Why is it that you think that people avoid putting together a succession plan? I mean, it's like, I guess it's it's like writing a will for your company, right? Basically, I mean, what do you think? What is the reason?
Because you're talking about mortality. It's what we see all the time. Nobody wants to think about mortality. Nobody wants to think about the end. So, honestly, the other reason that we see a lot of times is it's like doing things at home. I mean, you just find yourself caught up in the day-to-day activity of running a company and dealing with, home life and family issues, that this is a back burner item. It's not going to change your revenues tomorrow. It's not going to change your profits or banking relationships, how much money you owe. So it's something that's on a to-do list, but oftentimes just keeps getting pushed down.
Yeah, I think that there's a lot of folks in smaller companies that don't put a lot of weight in this whole thing and don't think much about it. And there's people who try to, LegalZoom comes to mind, and that type of thing, of finding online resources where they may go and, try to get a shareholder agreement or operating agreement, or find someone to help them. This whole notion of succession planning will not come up in those methods. And so, it may not be that people are intentionally ignoring it. They may not even be aware of it. So I think it's, we're probably preaching to a choir here, but it is, I think, much more useful to talk to a local professional who can sort of guide you than the other, because in my experience, and I've seen these things a number of times, more than a number of times, they just don't, they're very generic, these more online resources, and they don't address any of the issues that we're talking about today.
Yeah, I think that too, that the as Pat said, in the previous question, was when's the best time to think about this? It's when you start, before you start, when you're drawing up the organizational documents. Because once you start your business, as John said, you're absorbed every day and just keeping the lights on and getting the next sale and managing the HR issues and, the supply issues, and your focus goes every other way. And a lot of people, even if you ask them, and I, as a banker, sometimes have this conversation with people when they come in, and it's a relatively significant enterprise, and maybe it's been around for 20, 25 years. The owner is getting up in years, and they don't bring up what's going to happen. Do you want to retire someday? Are your kids involved in this business? And you start talking about it, all you get is a blank stare back. They haven't thought about it. They're just busy with today. And entrepreneurs, I think, and business owners in general, tend to be very focused about what they're doing today. to advance the cause of the business, to generate profit, to making Friday's payroll, then it just doesn't come up a lot. And I think it's not that they avoid it. It's just that it never seems to be top of mind with anybody until it's too late, until something happens. And it's like, damn, I guess I should have been thinking about this. And they find out that it can be a very complicated situation if it's thrust upon you without a lot of warning. And so I don't think people avoid it. I think that it's just mañana. It's like when you're young and you get your first job, do you worry about opening up your 401k then? No, you start worrying about your 401k when you're 55 and retirement is 7 years in the future. It's like, damn, I should have done this 25 years ago. And I think it's the same thing.
Yeah, and I think there's not an easy answer to the problem, and it creates the need for an exploration of a lot of questions that people just don't want to explore. And unfortunately, for many business owners, they haven't seen what Earl, John, and Sean and I have seen when you just see people who don't plan and just value wasted and the disputes that come out of it. And I assure you that if they see what we've seen, they'd be dealing with this thing tomorrow.
When you mentioned it, Pat, you mentioned this, and I think a couple other people did that. You should got to do your succession planning at the beginning. But one of the unforeseen things, let's say you're a husband and wife and own a business, and you do your succession plan, but what happens if the problem that the life changes, a divorce? Do you plan for divorce at the beginning? I mean, what do you do? What happens in a situation like that? I assume you don't. You're not going to enter a business. I assume you don't enter a start a company and say, well, if we get divorced, this is what's going to happen. I mean, is this something that people do?
I never address divorce between owners within a company agreement because if they're married, the entire and they're the sole owners of a business, it's all in the marital asset pool when they go to get divorced. We often write this, and we have it in the involuntary transfer sections of our agreements. And I've never really seen this happen. Maybe others have, but sometimes it's theoretically possible that if you're getting divorced, that a divorce court could order that sort of the non-involved spouse, non-owner spouse, be awarded that interest in the company, and that person then steps in with 2 or 3 other people who aren't particularly interested in having him there, and that's one of the trigger events for a buyout often. But in terms of the addressing the divorce between the owners, I think it's better left to a division in a divorce case.
Yeah, we've seen in a number of buy-sell agreements or shareholder agreements, they're one and the same. We've often seen where if it's owners that aren't related and they have spouses, we've often, we'll see where the owners have talked, the attorneys have worked with them, and the owners have gotten together and said, okay, look, if something happens to one of us, do we want that person's spouse to become an owner of this business? Do we want to work with that person? And if not, there's provisions right in the agreement that say, to stipulate that if something happens to one of the owners, that owner's spouse will have their interest redeemed or purchased either by an individual, by the company, what have you, based upon whatever the mechanisms may be within that buy-sell agreement itself. So whether it's if it's by death, oftentimes it's funded with insurance, so the company uses the insurance proceeds to do it. If it's not by death, quite frankly, it's more difficult. Yeah.
That's actually a good point. I think that when you can insure some of these things, and some of them you can't. But when you're writing a succession plan, you want to be careful to take care of the exiting person in terms of paying them the value of what they get, but you also can't take all the cash out of the company and kill it off at the same time. So what we most often do is write in a mechanism where a person is entitled to a payment up front of 5, 10, 20% of their entitlement, and then they take the remainder in a promissory note over a period of time, so the company can manage its cash flow going forward.
Interesting. I have another question from one of the attendees, and I have to say, don't shoot the messenger. I don't know what this means. So in case it's like really obscure, I'm not taking complete ownership of this. Do you recommend a 338H10 election? Is that
So
anything that, is that
I have
code
no
for
idea
something?
what that is.
Okay.
So, yeah, Patrick and I will understand what it is. So I'll give you the financial element, and then Patrick and Sean can talk about it. But essentially, what it is, it's for all intents and purposes, it's all being driven around taxes. So it means that the company is being sold as in the context of a stock sale, but is being taxed from the perspective of an asset sale, and it's providing benefits. As I said from the out earlier on, I said, why do you do stock versus asset sales? There's some benefits to the seller, there's some benefits to the buyer, depending upon whether you do one or the other. The 338H10 essentially tries to bring benefits to both parties.
Yeah, so let me give an example of it. So let's say you've got a company that's got a lot of contracts, and if we were doing an asset deal, I'd have to go out to each one of those parties on the other side of the contract and potentially get their approval to transfer those contracts. That could be very time consuming, difficult, and certainly, for sellers they've always had concerns about the ability or viability of those transfers happening. So in order to avoid that, we can do a stock sale, but for the buyer's perspective, have it treated and get all the benefits that John mentioned from an asset sale in terms of appreciation of value. Now, what we'll see, in those discussions, I think this is probably the piece, that I relate to my clients who are sellers is, because of that tax inequity, it creates a structure, on the operational side that's beneficial, but there's a winner and loser on the tax side of things that need to be addressed and equalized as part of the initial discussion, when you're talking about what the purchase price is. So a purchase price in a stock deal and purchase price in an asset deal, may be different because of, tax consequences. So when we're getting into that sort of level of sophistication, you need to be modeling this out. You need to be working with your advisors in order to understand, what the real ramifications are, because, beyond this is like the iceberg, beyond the 10% that you're seeing above the surface, there's 90% below the surface that really drives what the final answer should be.
Interesting. Okay. First of all, I want to say that at Yankee Publishing, our company that we're part of, the Business Review is part of, is I got an ESOP, an employee stock ownership plan, and that was put together basically because Yankee's a family-owned company and they're looking for what's going to happen in the future generations. Now, as an answer for that for succession, are there what are the benefits for companies for that, and are there certain companies that benefit more than other kinds from ESOPs?
Well, we've got the guy who can talk about ESOPs all day, on the call. So John, why don't we let you answer that one?
All right. So
That's why you were smiling, huh?
Yeah, I'm smiling. Yeah, we actually helped Yankee Publishing put their plan in place. So
I didn't. You know what? Full disclosure, I forgot about that.
yeah. So yeah, and this could be a lengthy, so I'll keep this very, very brief. But as with everything, there's pros and cons to an ESOP, and if a particular company situation is right, an ESOP can't be beat, quite frankly. But if you think about it, one of the benefits of it is that it allows a selling shareholder to sell their company to an ESOP and potentially defer or eliminate and not paying any capital gains taxes going forward. It allows a company or allows a situation to have the business transferred from the shareholders to the employees And because there's a number of tax benefits and financial benefits, and if that's the only reason somebody's thinking about ESOP, they're thinking about it for the wrong reason. But there's a myriad of tax benefits that come along to both the selling shareholders and to the company itself. The employees all become owners of a business. So for those that have the hair color like mine, they own a piece of the rock, so to speak, going way back in the day. But it's, what we see today is that there's a lot of the business owners feel like they wouldn't be where they are today, but for the hard work of the individuals. And while hopefully employees have been compensated well, the business owners want them to be able to take over the company on a go-forward basis. A lot of times we hear and see that, use Yankee Publishing as an example, they could sell, the business could be sold to a third party, but if a company sells to a third party, there are going to be changes in some way, shape, or form. And the legacy of the business may not be the same. Certain jobs and positions may be eliminated. In a sale to an ESOP, essentially what happens is that the ownership just changes from one day to the next to all the employees. The way the company is operated doesn't change. The way it's managed doesn't change in a perfect world. And like I said, I could really go into a lot of the pros and the cons and what have you, but in the right situation, it can't be beat. What I would say, a take-home message is that in order for a company to really be eligible and be the right fit for an ESOP, you're probably talking about a company with at least a value of at least $1 million, and that's on the low end. That's definitely on the low end. And you want to have at least 20 to 25 employees. There's reasons for that, and I don't want to take up everybody's time this morning on it, but for those listening in, if you're not at that threshold, if you're below that, an ESOP probably isn't the right way for you, but a co-op might very well be, which is another form of employee ownership. It's a different form, but a co-op might very well be.
I have another question along the lines of related to divorce. I am buying the company from my partner who is getting a divorce. We are keeping the same trade name, but moving it under a different LLC. Do I need to worry about the divorce affecting the future of business? Is this a question for a divorce lawyer?
Maybe.
Assuming that, everything's at arm's length and, there's not an attempt to manipulate values, then, there really shouldn't be, a hanging liability. The owner who's, subject to a divorce, they're going to go through a process to allocate assets, and, as long as it's been done at arm's length, then that should be an easy way to value that asset.
Yeah, shouldn't change the value.
Right. We only have like a minute or so left, and I was wondering if any of you have, if all of you have, each of you has a parting thoughts on this. Maybe some words of wisdom for our audience here about what their next steps might be.
Sure, we'll go in reverse order, I guess. So what I would say from we said it at the outset, we'll say it at the end. Whether it's, just plan. My father used to always say, don't take the ostrich approach. Don't put your head in the sand, wait 6 months, pull your head up and hope everything was going to take care of itself, because it doesn't. If you don't plan, somebody, whether it's within your family, within your company, the employee base, somebody is going to have the impact of that. Lack of planning, somebody probably besides yourself is going to feel the impact of it. So, and planning doesn't mean it's you got to spend hundreds of thousands of dollars. Planning just means just understanding what your options are and just plan for those accordingly. That's, to me, is the take-home message. And realize that there is no one size fits all, and there's plenty of options out there to be given to consider.
Right. Thanks.
Yeah,
So-
I would say the same thing. It's it would be incumbent on somebody to, get some information and speak with your advisors early. it's never too early to start getting some information and discuss what you think might be coming up. Even if it's not imminent, it at least gives you something to think about. Whether or not it's with, you know, your banker or your attorney or your accountant or your business advisor of some point. I mean, we all have a different perspective. We all have a little different slant on things. And the kind of things that if you walked into my office at Service Credit Union that I might say would be different than if you walked into your attorney's office and wanted their opinion about something. So I think to just like planning in general for this, you know, the earlier you do it, the better it is. If you're faced with something that you think may be coming down the pike, you know, all of us or any of your other advisors are very willing to talk with you about whatever these issues are at any time. So I would open up the dialogue as early as you can.
Yeah, I agree with what Earl and John said. I mean, these are problems that people have solved, and you know, it's starting. I think the hardest part is starting a discussion about it and getting informed.
Yeah, I agree with everybody, what everyone said. It's always do it early, but it's never too late. So, you know, if you haven't done it, you know, maybe now's the time.
Very good. That'll be the last word. I want to thank all of our panelists here. Earl Rossi of Service Credit Union, Patrick Clausen of McLean Middleton, Sean O'Connell of Shaheen Gordon, and John Murphy of Atlantic Management Company. And our sponsors are Service Credit Union, Shaheen Gordon, McLean Middleton, and the Atlantic Management Company. And I want to thank you all very much for joining us. And I'm sure if you have any other questions for our participants, they'd be more than happy to help you if you want to get in touch with them. And I want to thank all of you again. This was great. It was really very, very educational, I have to say. And thanks again, everybody.
Thank you, Jeff.
Thank you all.
Thanks, Jeff.
Pleasure.
Bye now.
All right.